We've never seen this before. Everybody is all in at the same time in exactly the same trade. Portfolio managers themselves, looking at the ICI mutual fund data, and I didn't predict this, that we're down to just over 1% liquidity ratio, cash to asset ratio for domestic equity funds. In the overall annals of financial history, we've never come close to being that low. Imagine, God forbid, if we ever see any redemptions. But those are the surprises. Those are the surprises, and the fact that we still have such huge inflows in equity ETFs with the valuations where they are, even if you're willing to take a long-term view of valuations, which is what I did. It might not be a bubble, but it's a mania. And I don't invest in either one of those.
On this episode of What the Finance podcast, I have the pleasure of welcoming back David Rosenberg. So David is the founder and president of Rosenberg Research and Associates. So David, thanks so much for coming back on the podcast.
Well, thanks for the invite. Pleasure to be back on with you.
No problem. I'm looking forward to the conversation. So as we're approaching the end of the year, I'd be really interested to hear your year review and I guess whether you've been surprised at the markets and the economy and what's been happening.
Oh, well, do we have 3 hours? The surprise. Well, I'd say that, let's say the biggest surprise has to be the U.S. stock market. Exactly a year ago, the consensus for the S&P 500 for the end of this year was 4,900. And here we're sitting almost at 6,100. And of course, everybody is, even the strategists and analysts are now momentum chasers, because now everybody is talking 6,500, 6,800, 7,000. But that's, there's not many years that you're off by 1,200 points on the S&P 500 on a consensus forecast. So that was the big surprise. The big surprise was that on an 8% earnings growth profile, the stock market's up almost 30%. Almost 5 points of multiple expansion in a 12-month span qualifies as a 2 standard deviation event. Doesn't happen that often, but that was to me the big surprise for this year.
Yeah, interesting. And I saw you sort of did a bit of an article. I think it was sort of the Lament of a bear, looking at maybe reasons why that were the case. So I guess maybe reasons why other individuals sort of got it wrong as well. So I'd be interested to hear from your perspective why you think this. We've seen this rally, and maybe it's sort of counterintuitive to what a lot of people expected to see.
Right. Well, I did what I think we should all do, which was do a reality check on our own opinions, especially when they don't play out. And so I wrote a piece called Lament of a Bear last week, and I wrote a sequel to it, putting myself in the shoes of the bull. And what did the bulls and what did the overall market, what did they tell us? What did they get right over the course of the past year? And I had ascertained that the leg of the bull market we're in right now really started. I mean, remember, we had a horrible year in 2022. And then in the spring of 2023, we get NVIDIA and the blowout numbers and the guidance. And I think we can date May of 2023 as the inflection point of this massive generative AI trade. Just as we could date the summer of 1995 when Netscape went public as the start of the internet mania. So this really started almost 2 years ago, and then it's cascaded into this year. And of course, it's broadened out. So what I had said was, under the proviso that we've hit an inflection point in the technology curve, that we've engaged in some sort of, I don't want to call it new paradigm, but let's just call it a model shift. And we've seen a shift in the technology curve with all sorts of future implications for productivity growth, and then what that means for corporate profits, since productivity leads to a lower corporate cost curve. And I was always wondering all year long, looking at all the classic different multiples that we look at, price to earnings and price to sales, price to book, the Buffett indicator, everything is just off the charts. And yet money is just plowing into the stock market like it's nobody's business at what I thought were these borderline insane or maybe just insane valuations. And then I realized that, well, if in fact we're in this situation where investors are looking at what AI is going to deliver in the future, then the investor class has naturally lengthened their time horizons. So they're looking beyond just the next year. They're looking at the next 5 years. And we saw this last during the mid to late 1990s, how investors reacted to the onset, the advent and proliferation of the internet and all its applications and all the assumptions that were made. So there's a lot of comparisons, similarities. There's differences, but a lot of similarities, because that's the last time we really had that sort of inflection point on the technology curve, and we know what happened. 1995, starts off as a internet bull market, turns into a raging bull market, then turns into a mania, then a bubble, and then the bubble bursts. And I suppose that, not really a conclusion, but just an observation that it's next to impossible to know. We're not in 1995 or 96, but maybe we're not in 99 or 2000. Maybe we're in, 1997 or 98 or 99. Where are we in this phase of the symbiotic relationship between a new technological innovation and the market process of pricing in the future? So I was willing to entertain that. That is the primary explanation, is that investors have lengthened their time horizons and are willing to ignore the classic valuation metrics that in the old days, I think would have had anybody concerned, or certainly taking profits, rebalancing the portfolio, diversifying. None of that has happened. That's really what caught my eye this year, was that the market is moving north in a serious way, and there's been no rebalancing. Nobody's rebalanced. Nobody's taken profits. Nobody is diversified. Everybody is all in. So a lot of this was trying to explain what is with this behavior. And I said, I don't think I'm going to call it a bubble anymore. I'll find something else to call it. Maybe it is just a mania. But I also said that maybe there is something beyond the mania that isn't completely irrational. Doesn't mean I agree with it, but in my piece, I tried to explain what it is that the bulls are seeing and what the bulls are pricing in that I didn't bother to do this past year. And that was the premise of the report.
Yeah, and it's always hard to do, or not hard to do. I think it's a good thing to do when we can, to look at the other, what are our opinions, what are the other sides, always challenging our thoughts. And I think it's it was really interesting to read your article. And if I look at it, it does seem that in 2022 we had earnings misses and higher inflation, but that's something that we haven't seen. Some economic concerns as well. Something that we haven't really seen in 2024, which maybe is sort of supported this continued rise as well. It's just been sort of, there's been most of the misses have more been on guidance lower than expected rather than lower earnings. Would you agree?
Yeah, even when we adjust for interest rates, the classic multiples are still historically at the high end of the range. I think that, inflation came down, and you would say ordinarily that should be positive for multiples. I would tend to agree with that, but a 5 multiple expansion under any circumstance is absolutely extraordinary. And as I put myself in the feet of the bulls, I try to ascertain, so the market is pricing in a future. What is that future? Let's go beyond just 1 year expectations. And we went back into 100 years worth of data to do this, to figure out what is the 5-year annualized growth embedded in valuations today. What's the market expecting? What's the market telling you? And this is what my report was about. My report was not pushing my view. The report was trying to explain that the market is telling you that it expects earnings growth to average 20% annually per year for the next 5 years. 20%. That is about triple the historical norm. Now, it did happen, by the way, in that period of the mid to late 1990s. Although I would argue, maybe I would call generative AI, internet light. It's not the internet. The internet was like electricity. That was a fundamental game changer in every meaning of the word. Historically, getting 20% per year earnings growth over half a decade is a 1 in 20 event. It's happened 5% of the time. So I'm not going to say zero, but I'm going to say that's the bet that the market has laid down, that the productivity revolution is going to be so strong that profits are going to be triple the historical norm over the next half decade. If you believe that, then this market is for you. Something else that was a surprise to me, back to your first question, was I did not anticipate that the equity risk premium would be wound down almost to zero. That the ERP, and no other country in the world has this dynamic except the exceptional United States, American exceptionalism. ERP is basically zero. So I didn't anticipate that stock market investors would be treating the stock market as a riskless asset, because that's what happens when the ERP is zero. The earnings yield in the stock market is equivalent to the risk-free rate. Call it treasury bill yields. So the market's telling you that the equity market has become a riskless asset class. The stock market is telling you that it will not go down. And I suppose with Donald Trump's electoral victory, that view's been even emboldened, because there is this pervasive view that Donald Trump is bigger than human nature, bigger than the market cycle, and that the government will not let the stock market go down. And that's layered on top of the view that because of AI, the market is not going to go down. Now, if you have that belief that the market is not going to go down, you should be all in on the S&P 500. But you see, that is the message from the market. That's what I wrote about. I'm not a believer, but this is what I missed. I missed the fact that the market would go in and ahead and price in 20% earnings growth for the next 5 years, which is a 1 in 20 event. I missed that. And I'm not going to say I missed it, because I still don't necessarily believe it, but sure, would have been nice. Would have been nice to participate in a 30% total return on the S&P this year. But, I also had gold, and gold did just as well. And there were other markets around the world that I liked, where actually the equity risk premium is positive, which means as an equity investor, you're getting paid to take on the equity risk. And, it's not just the stock market. Again, you asked me about the surprise. Did I think that by this time last year, did I forecast that things would get to such an extent that the yield on a Ginnie Mae mortgage bond with the implicit government guarantee at, call it roughly 5.5%, would be at the same yield as a BAA corporate? So the same thing is in the bond market. The bond market's telling you that a corporate bond with a 2% default risk is being priced the same way that a government guaranteed mortgage bond is being treated. So what I'm saying is that the concept of risk, that is really the big surprise, or the big theme of 2024, was how the concept of risk was so totally altered over the course of the past 12 months, where you can't differentiate between a guaranteed mortgage security and a corporate bond, and the stock market and a treasury bill. That's something to think about going into next year.
Yeah, that's amazing. I think the credit, as you said, the credit spreads have been so, you know, I'd be interested to hear you've mentioned those sort of assets, but has it been the same sort of throughout the risk curve, or it seems to, from what I've seen, it seems to be very tight.
Mm. It's all part of the same speculative trade. Bitcoin at 100,000. Well, what did Bitcoin do to get to 100,000? It took Donald Trump to get elected. It was hovering around 70,000. It's all speculation, and it's all part of the same risk-on trade. Credit spreads, you see, once again, stock market is priced in a way that investors believe it will never go down. And credit investors now are basically priced for there to be zero defaults. We are priced for zero defaults. So in an equivalent way, that what you'd call like the equivalence of the ERP in the bond market, saying the same thing. We are entering into a world, no defaults, and entering in a world where the stock market will not go down. In fact, the market's telling you, and the ERP is zero, that for you to be fully invested in this market, you have to believe that there will never be any sellers. There will never be any sellers. And I guess it comes down to, once again, your first question, Anthony, which is about the big surprise of the year, that everybody talks about the mountain of money on the sidelines. Well, maybe it's a hill now and not a mountain. When you look at the inflows of ETFs, I'm blown away. If you look at the chart of the inflows into equity index funds, passive index funds, that chart looks like Bitcoin. I'm astounded. I'm astounded that we are now up to 60% of the market cap in passive index equity funds. I mean, when John Bogle first unveiled the ETF in the mid 70s, he said this market will never get more than 20% of the total capitalization. We're getting towards 60%, and the inflows are incredible. Looks like a dot-com stock in 1999. And so this is all part of the momentum. And of course, it's all part of the self-reinforcing upward spiral, because these index funds have to invest in the index. And for the public, general public investing, they don't even know what they're buying. They don't even know what it is they're buying. They couldn't tell you one stock in their portfolio. And why bother when you think about it, investing with an active manager when 3/4 of them have underperformed the index and the index is so much cheaper? But then again, active investment management is not blind investing. The portfolio managers or the CIOs, they're skilled. They have their CFAs. Nobody's perfect, but they do look at balance sheets. They do look at income statements. They do look at valuations. But when you're investing in ETF, there's none of that, and that is an unremittent bull market. The bull market at ETF investing, and that money has to be put to work. I guess I didn't anticipate at this stage that when I look at the household financial asset mix, 70% is in equities. Only 12% is in bonds. And that's true. This is from the Fed flow of funds data. Of course, bonds are for losers. You're not going to talk about bonds at the cocktail party. Nobody want to have a conversation with you. And the rest, of course, is in cash. But we've never been at 70% before in terms of the concentration of equities and household balance sheets, not even during the internet era of the late 1990s. This is off the charts. And when you look at baby boomers, the 80 million pig in a python, baby boomers like myself, we should be between 30 and 40% in terms of the life cycle in equities. They are over 60% in their asset mix. We've never seen this before. Everybody is all in at the same time in exactly the same trade. Portfolio managers themselves, looking at the ICI mutual fund data, and I didn't predict this, that we're down to just over 1% liquidity ratio, cash to asset ratio for domestic equity funds. In the overall annals of financial history, we've never come close to being that low. Imagine, God forbid, if we ever see any redemptions. But, those are the surprises. Those are the surprises. And the fact that we still have such huge inflows in equity ETFs with the valuations where they are, even if you're willing to take a long-term view of valuations, which is what I did, it might not be a bubble, but it's a mania. And I don't invest in either one of those. But that's really the story for the past year. I come back to the fact that the whole concept of risk has been turned upside down. And it started 2023. It's not just a 2024 story, but it's a story that we're writing more chapters, but it is accelerating. And I'll tell you the truth, it's a concern to me. And I'll tell you why. It comes down to, and I talked about this in my report. I am a student to Bob Farrell, the dean of Merrill Lynch research for 50 years. Bob Farrell's 10 market rules to remember. Everybody should have those pasted onto their Bloomberg terminal or their computer. And rule number 4 is that exponentially rising markets go further than you think, but they don't correct by going sideways. So there's your story for 2024. Exponentially rising markets go further than you think. And this market went further than I thought, that's for sure. But because the consensus was 4,900 for the S&P a year ago, it's gone further than everybody thought. But it's the second part of rule number 4 that concerns me, which is that these do not correct by going sideways. And I don't know when the peak is going to be. I don't know what week, month, or even year. Okay, I remember Chuck Prince back in the summer of 2007 telling everybody, you got to keep dancing till the music stops. But I don't think he knew or anybody knew that the music was going to stop 4 months later. But there's a lot more at stake now because of the exposures and the concentration of risk on household balance sheets. That to me has to be most unnerved. What happens when everybody thinks they're going to try and time the peak? You see, the one thing that has not been repealed, and not even Donald Trump, is bigger than Mother Nature. There is the market cycle, and there's peaks and troughs and bull markets and bear markets. And I'm really concerned that when the peak comes and everybody thinks they can time it and they try and get out at the same time, there's not going to be any bid. There will not be any buyers on the other side because everybody except maybe me and Warren Buffett. And I guess, you put me and Warren Buffett in a room together, I guess if you took the average, I'd be a billionaire. But there will not be enough buyers on the other side. I'm really concerned about the next bear market whenever it comes because it's going to be very severe. I'm not talking about the great financial crisis. I'm not talking about bank failures, but I think it's going to be as bad as what we saw in 2000, 2001, 2002. And that was no picnic, and no bank went down in that period. It was not a picnic. I don't know when it's going to start. I'm not going to lose any sleep over trying to even time it. I just know that when it happens, just as the buying through the ETF mechanisms was a self-reinforcing development, when the movie rewinds, it's going to look a lot different, but in perfect symmetry. And that's what has me concerned. And I think everybody in the call should be wondering, why does Warren Buffett have 30% in cash? What is he saying? You see, people say to me, that's why I wrote the report. What does the market see that you didn't see, Rosenberg? Or what did you see that the market didn't see? You got to come clean. I came clean. It was a nice cleansing exercise, checking my blind spots, admitting that I made a mistake not being long the stock market. So I'll come clean and I'll provide a rationale and explanation. But nobody says, why is Warren Buffett 30% cash? The only person I know asking that question is me asking it to myself. But I think I know the answer. I think that he's saying the same things that I am.
Yeah, it is. There do seem to be a few investors who sort of in similar positions. As you say, they're looking at valuations, and they're sort of extremely high, but there's this exuberance behind everything. Are you concerned that there's sort of a secular shift in bonds? I know, it's probably something that's only been talked about the past few years with 40-year bull market, and now we could be going the other way with the challenges that governments are going through, the potential for financial repression, the real rates potentially being negative for years. What do you think that's a possibility, or you still don't think that's could be the case?
Well, people talk about, that the 40-year bull market on bonds is over. Well, I don't know how you want to define that, because, look, we bottomed on the 10-year note barely above zero. So that's a bit of a no-brainer. I don't think, barring another financial collapse or another, destabilizing pandemic. Okay, no, I don't anticipate we're going back down to zero on long duration bond yields. I'd say that if you're going to, the secular is very difficult to predict. Do I think that bond yields hit bottom during the pandemic? They probably did. Do I think that bond yields are going to go up from here? I think right now we're trading in a range. I think there's a lot of confusion over Trump and, what is, what are threats on tariffs? What will be reality? What will we be able to get through on fiscal policy in terms of fractious House where the Republicans have a razor-thin majority and replete with fiscal conservatives? There's lots of uncertainty right now as far as politics are concerned. The stock market has laid down its bets that Donald Trump's going to be very bullish for equities, and it's obviously a very business-friendly administration, and that much is true. That said, I don't think that Donald Trump is bigger than Mother Nature. So, people were very bullish on the stock market when George W. Bush took over, in 2000, and he didn't exactly preside over a great stock market. Events, took hold that were hard to predict. And of course, the same time that the tech wreck started to unfold, people turned very bearish on the stock market with Barack Obama, but he presided over a great stock market. I think the tie-in from stock market to presidents is a loose one, but everybody has to fit the story or the narrative into the price action. Look what the stock market did under Bill Clinton. It was fantastic. Okay. The bond market, it really comes down to what's the Fed going to do? What's the Fed going to do? And the Fed will do what it does, premised on where is inflation going and what is the economy going to be doing. I have a strong sense that, notwithstanding the bumps in the road in the past few months, that the disinflation momentum, I have a whole range of reasons why I'm not worried about inflation. I think this time next year, headline and core will be well below 2%. I think we're seeing a break in the rental series, which is very encouraging. So I think that inflation will be coming down on a trend basis. And I think the economy, whether we go into the recession or not, and of course that feels like a stale call at this point, but I think the economy is going to be weak enough that, and with the unemployment rate on a rising path, that the Fed will be cutting rates more than what the markets got priced in. We got the 3.6% on the 10-year note in September around the time of that meeting when they went 50 basis points, but under the proviso that the Fed was going to be aggressive next year. And then, the Fed was like, Lucy and Charlie Brown, pulling up the football. The next thing you know, the Fed's not going to be that aggressive in cutting rates. And so we go from 360 to 450 to 415, now we're 430. So we're just backing and filling. But it's all the gyrations in the bond market you've been seeing has really been influenced by the Fed. It's not been influenced by fiscal policy or supply issuance for that matter. It's all been about Fed expectations. So the Fed probably cuts in December. That's priced in. They skip in January. But then we have the March meeting. Everybody believes, as I do, that the four dot plots for rate cuts next year becomes 2. And then I believe when we get the next set of dot plots in March, it'll be back to 4. Because the beauty of this is that by the March meeting, we're going to have the benchmark payroll revisions. And based on the QCW, looks like that non-farm payrolls have been overstated in the past year by 1.2 million. And so I think just in time for the March FOMC meeting, we're going to get a whopper of a downward revision to payrolls. I think the Fed will go back. The Fed, I mean, those dot plots move around like Bitcoin does. But I think that, like the market right now is priced for the Fed to be done at 3.7% on the funds rate. And I think we'll be at 3% or lower on the funds rate by the end of next year. I think we'll be at neutral or maybe a bit below. And if that's the case, and it's not a secular view, let's take it a year at a time. I think the 10-year note will be back at 3.5%, which is about 80 basis points lower than we are today.
Okay, makes sense. So for next year, you sort of think it'll be sort of weaker. There'll be some weak economic data coming through, continuing the current trajectory of rate cuts, and then, obviously potentially beneficial for the markets. We'll have to wait and see depending on what happens. But that's what you're saying, or that's what you think will happen next year.
I'm right now neutral. I'm right now neutral. Like, don't forget, it's like everything else in terms of the risk. I'm not telling anybody to add to bonds right now. We have to get to a situation where the market starts to price in more Fed rate cuts because you have a flat to inverted yield curve. So to be at the 30 or 10-year part of the curve, you're going to get a better yield than 3-month bills without taking on the duration risk. So I'd say have your liquidity, have your powder dry. I'm not talking about the stock market. Powder dry is always what equity market people talk about. But in the bond market, I'd say that there's going to be a good opportunity in 2025 to go long the treasury market. You don't have to jump in right now. But I'd say, though, in the next few months, there will be a good opportunity. Just right now, you're not getting paid to be at the long end of the curve. And there's duration risk, and there's a risk that I could be wrong. So better to be at the front end or to be in treasury bills. But I do believe that if you're going to ask me, what's the next big move in treasury yields? What's the next 50 to 100 basis point move? If I'm going to draw the bell curve for everybody, I think the next big move in yields is going to be down, not up. That's the main premise. And I say that with everything you mentioned about fiscal policy and issuance. I get the question all the time. Look, from the October 2023 peak of the 10-year treasury note yield to the low in yield in September of 2024. We had the 10-year note yield went down to 140 basis points in the face of over $1 trillion of deficit finance. If I told you in October of 2023 at 5% of the 10-year note what fiscal policy and bond issuance was going to look like, you'd have said to me, well, we're going to 5.5 or 6, but we didn't. We got, at least for a day, down to 360 on the 10-year note. And all that is because of the shifting expectations of the Fed, the cost of carry, the term premium. Nothing matters more. Fiscal policy, bond issuance, that is a 20% correlation with 10-year yields. It's not zero, but the 90% correlation, okay, the key nugget is the Fed. The Fed is the most important determinant, not just of the overnight rate, but yields right across the curve. And I think that the Fed is going to have to get to neutral. Look at the fact that as it stands now, the unemployment rate is at 4.2%, which is the Fed's long-term estimate. So we're in equilibrium in the labor market. And in fact, if the participation rate hadn't gone down the past 2 months, the unemployment rate would be at 4.5% right now. So I think that we're going to build to a situation where labor market slack is going to continue to widen. Unemployment rate is going to drift up. And I think that as I'm tracing through the most important determinant you see in the inflation data, if you get the rental components right, you will get the story right, because rents and OER are 35% of the index. And I'm seeing a break in that series. Now, under the proviso, because everything is built on assumptions that everything else stays the same, we're going to get a huge decline in inflation next year that I don't think most people are anticipating. Most people think inflation is going to go up, or they think inflation is going to be sticky, or they're nervous about tariffs, which we don't know what the size is going to be, or if they're going to come at all. Is it a tactic by Trump? I mean, who knows? We only know that he brought in tariffs in his first presidency, and there was no discernible lasting impact on inflation. So I think that the out of consensus call for me for next year is going to be that the disinflation momentum is intact. People are surprised by how low inflation goes, and that the economy is going to weaken. Whether it goes in a recession or not, that remains to be seen. I don't even need that. I don't need that to be bullish on bonds. We had a 140 basis point rally in the Treasury market from October of 2023 to September of 2024. It didn't require a recession. The economy came off the boil, unemployment rate bottomed, inflation started to come down, and the Fed signaled rate cuts, and then it delivered. And I'm expecting more of the same on a trend line in 2025.
Okay, makes a lot of sense. So I know, you mentioned there previously that you've sort of been very bullish gold this year. I know you've mentioned Japan in a previous, I can't remember how long ago that was, but in a previous conversation we had. But yeah, is there anything else that you really like at the moment that you're sort of watching, or as you said, he's just sort of neutral? And
Yeah, sure. Well, like I said before, I mean, look at those Ginnie Mae bonds at like 5.4%. Take a look at those. That's a good place to park money. I mean, safe and sound insofar as that still appeals to everybody. Gold, I still like the characteristics of gold. I think the bull market is intact, and gold, to little fanfare, has done as well as the S&P 500 has done this year without the equity risk. Japan is still a long-term hold for us for a variety of reasons, and we added back in the spring Hong Kong. We like the emerging Asia story. We just don't want to be exposed to China, given all the geopolitical and trade risk with China. But Hong Kong is a surrogate to play that, and that's worked out extremely well. When the Hang Seng got to an 8 multiple, I said to my team, "Look, this was back earlier this year. I said the 8 multiple was the low in the bear market that ended in the summer of 1982 in the United States." And we got to that level. An 8 multiple, yeah. When anything gets to an 8 multiple, unless it deserves to be there, you want to start adding positions. And so Hong Kong, the Hang Seng's been a good place for us to be. There's been, that's what people don't realize, there's been other areas, beyond the S&P 500 that we've done quite well this year. We actually, believe it or not, I at the risk of getting too geopolitical, we put out a buy recommendation on the Israeli stock market a year ago, and everybody went just crazy on us. And look what it's done, and then look what it's done since the Trump victory. And then hopefully we're going to get we have one ceasefire deal. Maybe we'll get another one. But that was another a market that just cheapened up just way too much. Notwithstanding, I mean, at some point you got to say, yes, there's war, there's economic risks, but at what point does it get overly priced in? So there's a tiny little emerging market that's also held us in pretty good stead. But yeah, I'd say that if you're going to be in the U.S. market, and we're not zero in the U.S. market, but there's a couple of spots that look good for us. We like the interest sensitives. We have liked the utility stories. I think that financials, as much as a no-brainer could ever be, especially because we know we're going to get a huge M&A craze, and we're going to have a much friendlier regulatory backdrop. Financials probably are going to be, if you're going to be in the U.S. equity market, the financials would have to be your top sector pick. And that's basically it. I'd also say, look, cash is not trash. You're getting almost 4.5% in cash, and you're getting 5.4% of those Ginnie Mae bonds. And I would say even munis after tax right now, effective yield at around 6%. I'd say this much. I think rates are coming down. I think rates will continue to come down. We just got a slew of rate cuts out of the Bank of Canada, the Switzerland, the ECB. We're still in a downward rate cycle, even if the Fed takes a pause in January. And so yield is going to become scarce again. And when yield becomes scarce, you want to own yield. And so there's some safe yield out there that is actually very attractively priced. And in the stock market, I'd say once again, in an environment where the earnings yield could scarcely be lower than it is, focus on the dividend yield and dividend payouts. And then you could see that there's selective REITs and utilities, even telecom, and I'd say and financials, that are areas that you can dip your toes in, even in the S&P 500, which overall I'm still bearish on, but there's components of it that I like quite a bit.
Yeah, great. A lot to see there. And I think today I saw some data where the UK had the first, maybe, not saying that it should be invested in, I think it had the first ETF inflows in 4 years for the month, positive inflows for 4 years, which is quite an interesting stat. So you wonder, maybe that could be an opportunity. Probably lots of issues there as well. But yeah, David, thanks so much for your time today. Really appreciate it. And we sort of had some technical issues, so I'm glad we were able to sort that out. But my last question is, what is one message you want people to take away from our conversation?
I would say that heading into 2025, think of safe yield and think of diversification as not being a dirty 15-letter word. It's probably going to help you a lot in 2025 in terms of preserving what you already made in 2024. So wave concentration goodbye and say hello to diversification.
Great message. So thanks again for your time. If anyone wanted to find out more about your work and what you do, where would the best place for that be?
Well, just access us through information at rosenbergresearch.com. And one of my client representatives will get in touch with you and let you get onto a free trial. And hopefully you'll kick our tires, like our stuff enough that you want to become subscribers. That's one way, or you can just Google Rosenberg Research and go on the website and surf the site. Either way, you'll find a way to get on. If you want to get on the research, it's not too difficult, and we offer free trials because we like people to know before they sign on exactly what it is they're getting into.
Great. I'll put in the description, but thanks again for your time.
Take care. Enjoy the holidays.
Hey everyone, thank you for listening. I really appreciate the support. If you've got value out of this, I'd really appreciate it if you could like, subscribe, or comment, good or bad feedback. I'm always open to that, but it really helps with the channel. As I said before, only about 14% of people actually subscribe to this channel. So if you were to that, it would really help. It could mean we could continue to grow. If not, thanks for watching and see you on the next show. And you also might like this video right here. All right, thanks again.